Hello and welcome to another exciting segment of Community Essentials. I'm your host Nisakura, and today's guests we have artists D.E. Rania and Perry Feralla from Wintrust Mortgage. Enjoy. Hello and welcome to Community Essentials. I'm your dynamic host Nisakura, and I'm sitting here with Perry Feralla, a loan officer of Wintrust Mortgage. How are you doing today?
Great, thank you. Thanks for having me.
Absolutely. Now, the most important thing that people want when they, they put forth effort to, establish something in life, they want something that they can be responsible for. They want to, have something comfortable to call their own. We're talking about a home.
Absolutely.
Now, what's one of the most important things to know and learn when you're beginning that process?
Part of the process really is taking a look at your credit history, your current income, assets that you might have for a down payment, and then the type of property that you might wish to buy. Different mortgages work according to different types of properties. So when thinking about buying a home, your first house, particularly as a first-time buyer, take a look at what your debts are every month. Take a look at what your gross income is. And that's how loans and mortgages are really calculated. Take the gross income per month, and then we usually use a 41 or 45% ratio of that. So multiply your gross income by 41%, let's say. Then from that number, subtract any car payments, student loans, minimum credit card payments, things that you pay regularly every month, like health club memberships, for example.
Right.
Then what's left is the amount of money that we'll have for the principal and interest payments, real estate taxes, condo, if it's a condo, there's a condo assessment, and home insurance. And that's how we can get to a point where we can sort of reverse engineer people into a price point and a loan point that's comfortable and appropriate for them.
Okay. Now, mortgage rates, where do they come from and what are they?
Mortgage rates have to do with activity in the U.S. bond markets. Most long-term mortgages come from U.S. Treasury notes, 10-year U.S. Treasury notes typically.
Right.
That's where the activity is every day that decides where mortgage rates are. And then from that, there's a little bit of a spread that the various banks add. But our long-term U.S. mortgage rates are not really controlled directly by any entity of the government, which is a common misconception. They're controlled by activity in the U.S. Treasury bond market on any given day. So when you see that the yields or the interest rates on those bonds have risen, you'll know that mortgage rates typically tend to follow. And then the reverse is true as well.
Okay. All right. Now, Perry, tell us, what's a typical down payment for a house or a condo?
Typical down payments can vary by the type of loan that you use. There's really two main loan types now in this country.
Tell us about them.
The ones that are insured by the Federal Housing Authority or FHA insured loans, and the ones that are conventional or non-FHA. And you might have heard the terms Fannie Mae or Freddie Mac.
Right.
Those are two government companies that really buy up most of the non-FHA mortgages in this country. And the FHA insured mortgages have a lower down payment threshold. You can buy a house or a condominium or a townhouse or a two-flat with an FHA mortgage using a 3.5% down payment.
Wow.
But in non-FHA lending, the loans that Fannie Mae or Freddie Mac would buy, the minimum is at least 5% right now.
Right.
And when you buy with less than 20% down, you might have heard that you have to have private mortgage insurance in those so-called conventional loans. And then the private mortgage insurance companies also have limitations in terms of credit score and down payment. So the particular type of property that you may wish to buy may require more than a 5% down payment with a non-FHA loan.
Right.
But recently, FHA lending has become very, very popular because it requires the minimum down payment of 3.5%. And that down payment can all be a gift, by the way. So if you want to get a gift from your relatives, your parents, etc., you can get your entire down payment, 3.5%, gifted for an FHA insured loan. And then another good technique to know is that the seller who's selling you the property, you can set it up in your contract to have the seller pay all of your closing costs.
Right.
And in FHA lending, that can be up to 6% of the sales price of the house. So you can literally get into a house or a condo or a townhouse with an FHA loan with your 3.5% down payment, have the seller pay up to 6% for all the closing costs, and the closing costs are not really 6%, but you can also use some of that money to buy the interest rate down to make it more affordable every month. So in FHA lending, that has become much more popular
Right.
more recently than it ever was in the past.
Now, is that one of the simplest types of mortgaging?
Yeah, one of the simplest types of mortgaging would be on a single-family house, because you have no condo association to deal with,
Right.
you don't have other owners to deal with,
Mm-hmm.
you don't have any of the legal restrictions of condominium ownership. So a single-family house, a two-flat, or what we call a fee-simple townhouse, is also a very simple property to finance with an FHA loan or a non-FHA loan these days.
Okay. Now let's talk about credit.
Credit history is really important.
Mm-hmm.
There are minimum credit scores that are looked for in terms of FHA lending or non-FHA lending. Right now, most of the FHA loans have gone to a standard credit score of 620.
Mm-hmm.
However, with exceptions and extenuating circumstances, there are FHA loans available down to credit scores of 550.
Mm-hmm.
In conventional lending, a 620 is also minimum, but again, if you're using private mortgage insurance companies, they also will impose their minimum credit score requirements as well, which may be higher.
Now, I have to ask you an important question that a lot of people run into, that are trying to buy houses and gain property. How do they fix or improve their credit scores?
In fixing or raising up your credit scores, and it can be done in different ways. It depends upon what your particular situation might be. But one thing that I see a lot of is very high balances on credit cards, let's say.
Oh.
So one way would be to pay something down to
Right.
lower the utilization of the credit. That will raise your credit score itself.
Mm-hmm.
If you have an old cell phone collection or a medical collection,
Yes.
it might be wise just to go ahead and pay it off and not let it accrue. If you have a bill that's in dispute, it might be wise to get the documentation to prove that you did in fact pay on time, and then go back to the creditor and present the documentation. And you can usually work that out within 30 to 60 days.
Okay.
And for more complex situations like past foreclosures or past bankruptcies, many times it has to do with the amount of time that's passed since that occurred, or getting all of your documents together from your bankruptcy to show what actually had been cleared off, because many times those creditors aren't reporting to the three bureaus
Right.
that those debts really are gone,
Yeah.
and that will raise the credit scores as well.
Absolutely. Now, what are some of the special programs that are available for, like, say, first-time home buyers in Illinois?
First-time home buyers in Illinois, right now the programs are a little bit more limited than they have been in the past. One organization is the IDA loans, IHDA, the Illinois Housing Development Authority.
Okay.
Sometimes we'll have affordable housing money for different counties and communities. Within the city of Chicago, there's still a program that's federally funded called TaxSmart that will provide an annual direct federal tax credit based
Right.
upon the amount of mortgage interest one pays every year of 20%. That's a
Okay.
great program for first-time buyers. And different communities will sometimes have their own programs for first-time buyers that they fund. Occasionally an employer might have one, or a local church or community organization is another good place to look for that.
Okay. Now, how can I figure out just how much of a house I can afford? Can I, an old lady in a shoe type of house, or a condo mansion type of house? How can I find that out, Perry?
Well, one of the important changes in lending over the last year or two is that it's very important that the size of the loan be appropriate to the income of the buyer and the credit situation of the buyer. And so all of the exotic loans where buyers didn't have to prove their income, those are all gone away because they got into too much trouble, obviously. So all the loans now have to be fully documented. So no one would be getting a loan that they really can't afford, so that's protection for both the individual buyers and the communities as well.
Right.
One way to do that is take a look at your annual income. If you have bonus income, go back 2 years and get 2 years history of your bonus plus your base salary. That's what we look at. We typically take 2 years tax returns, 2 years W-2s if you're a W-2 employee. And we just take a look at, again, that debt to income ratio. Typically, we don't like to see it much higher than about 41%.
41%,
But it
okay.
can be higher, given everybody's individual situation. Credit history, assets also are a compensating factor. And typically, though, if you take your monthly gross income, multiply it by 0.41, take that number, subtract all your debts and obligations, what's left is what can be used for your housing expense.
All right.
It's a simple, surefire way not to make sure that you're over borrowing and overstretching, which is something that no one really should be doing.